I am Christina Shervinka. I am the COO of Five Buffalo Capital, and Five Buffalo Capital is the fund sponsor for the Five Buffalo Capital or Five Buffalo Growth Fund. So, anyone interested in investing in multifamily real estate, we'd love for you to check out our website, which is fivebuffalocapital.com. Same place where you registered for the website. There's also a link to get more information. Our fund is restricted to accredited investors, but this webinar is not. So this webinar was a thought of Paul and myself of how we could help people who are trying to navigate their financial plan and also have an interest in investing in real estate. And so in that, I will turn over the conversation to Paul Herbs from Equity Trust.
Thank you very much, Christina. Really appreciate the opportunity today, and want to extend a thank you not only to you but to Five Buffalo Capital as well. Really appreciate the opportunity to speak about self-directed IRAs and 1031 exchanges today. What we're going to cover today and what we're going to learn and demystify is how people can access these tools that the wealthy have been using since the 70s, but most have not had access to. And then we're also going to learn how we can avoid and mitigate needlessly donating to the IRS and rather use those funds to passively invest in real estate. So without further ado, my name is Paul Herbis. I'm here with Equity Institutional Services, an entity of Equity Trust Company, and I'm very excited to be here today. I'm going to speak a little bit about our organization, what differentiates us, and then we're going to jump into self-directed IRAs. A subset of that will be checkbook IRAs. After that, we'll turn gears and get to talking about 1031 exchanges and some common strategies that I see used in the world of 1031s. And then after that, as Christina mentioned, we're going to open it up for a Q&A. So make sure to come with those questions. We'll get to them here at the end of the presentation. So a little bit about us here at EIS, Equity Institutional Services. We were formerly known as Midland Trust up until 2023 when we were actually acquired by Equity Trust Company in August and rebranded to Equity Institutional Services. There were a few prongs into why we were acquired at that time, one being our 1031 exchange business that has existed now for just over 26 years. Equity was looking for a way to horizontally integrate another facet of their business where they could help people also defer capital gains taxes outside of their retirement accounts as well. Another belief I hold into why we were acquired is going to be in regard to our team here at Equity Institutional Services. We were actually recognized by Forbes Advisors as being the best custodian to use when it comes to private equity investments, with many of our clientele going ahead and investing in real estate syndications. I know here on the slide, it currently says that we have $45 billion under custody. That's actually recently bolstered to over $60 billion here, making us one of the largest custodians of alternative assets. Equity Trust Company is the oldest custodian of alternative assets, being around for just over 51 years. Currently, we have over 334,000 account holders, over 400 associates, and we do just over 2 million transactions a year. That beautiful building that you're going to see here on this slide is going to be our headquarters in Cleveland, Ohio. I reside, and I'm speaking to you here today in Sioux Falls, South Dakota, where we're chartered with the South Dakota Division of Banking. We also have offices in Chicago, east of Willis Tower, and then in Fort Myers, Florida as well, which is where many of our 1031 team resides. So what is a self-directed IRA? It's a buzz term. It is a marketing term used by many different custodians. It's similar to any other type of IRA. Whether that's a traditional or Roth, it's going to have the same exact rules. It's not what type of account you're opening, but rather what custodian you're using to also administrate your funds. A lot of those larger custodians, I know we have the Super Bowl coming up here this weekend, so think of those that would advertise kind of during that halftime show, or maybe during those commercials. Think TD Ameritrade, Schwab, JP Morgan, Raymond James, and the like. A lot of them have completely built their business around traditional investments. Well, Paul, what are those? Those would be mutual funds, bonds, stocks such as the S&P 500. And what people think when they think of a traditional investment. We have built our industry as well as our competitors on being able to provide what they would not, which is an access to investing into alternative assets. There are many, many different types of alternative assets that we custody here today. Real estate, private equity, futures, foreign exchange, secured and unsecured notes, even cryptocurrency funds. So a wide array of investments can be made. My personal favorite being that in the real estate world. I enjoy those low volatile investments that appreciate over time. And then once again, that self-directed IRA custodian is really going to be the differentiating factor to go ahead and ultimately get you invested into those offerings. Most custodians won't allow you to actually go ahead and use your IRA at their facility to get invested into these offerings. They really care about their assets under management, so they'll actually give you a menu to pick from of their mutual funds. There's a financial incentive in there for you to go ahead and choose one of those assets under management. Where we at Equity Institutional Services and Equity Trust Company do not hold any assets under management. All of our investors direct their investments into alternative investments such as a real estate syndication like 5 Buffalo Capital. Now, a self-directed IRA really lets you go ahead and get in the driver's seat in terms of your IRA investment. It allows you to be the one to choose where those funds go and where they can be invested. I once had a client a few years ago now who was invested into an international real estate fund with a larger custodian. I won't say the name, but I had asked him, well, what countries are you invested into in this fund? And he turned around and asked his advisor, and no one had a clue into where his dollars were actually being funneled into that investment. So this really allows you to have that level of comfortability, especially when you're investing with people you like, know, and trust, because it's going to allow you that ability to go ahead and know where your dollars are going and know where they're being invested and what communities they're being invested into. I know that's a really strong reason that many investors really enjoy that self-directed IRA route. There's also many choices. Now, Paul, what can I invest into? You cannot invest in S corporation stock or life insurance. Outside of that, there are many, many choices to invest in. Most IRAs are funded by old 401ks. I want to call out that distinction here. There are instances when employees can roll over their active 401k, and it's known as an in-service rollover. Now, this is typically the exception and not the norm. I see about a third of investors able to actually go ahead and do these in-service rollovers. There's typically an age requirement of at least being 59 and a half years old. But what I tell every client I work with is it's worth asking your plan administrator to see if you can do an in-service rollover if you have an active 401k. The worst they tell you is no, and then nothing would change. But with former 401ks is when we will commonly see people want to go ahead and take control of their investment. Once when they're separated from that employer, those are their retirement funds to invest as they see fit. Now, some different advantages that our investors speak to when using self-directed IRAs. The number one advantage is certainly going to be a tax advantage. You will not be paying capital gains taxes on those returns that your IRA makes. So it is a powerful tool when investing, especially in investments that you believe in and feel comfortable in, because you will not be paying that capital gains tax when those funds flow directly back into your IRA. It's actually the reason that I'll work with clients who are past age 59 and a half to where they could take a distribution of cash without an early penalty, but they would rather continue to contribute to their IRA and continue to invest with it because they're tax savvy investors and they don't want to go ahead, claim it as personal funds, invest it as personal funds, because they would then be subject to those capital gains taxes. So it is a phenomenal way to go ahead and really take advantage of that tax benefit when it comes to an SDIRA. Investment options are another reason that people will use these to get invested into other alternatives. It provides a phenomenal way for investors to remain liquid and still get into these alternative investments. Administrative fees are another reason people really enjoy self-directed IRAs. We charge flat fixed fees, typically of amounting to $555 in the first year of account opening and $350 per asset they're invested in thereafter. So when it comes to an administration fee, many different custodians will actually charge percentage points when it comes to managing those accounts and managing those investments. So certainly we've seen investors actually save when going ahead and electing to do a self-directed IRA if they are on any other fee schedule like that. And then true diversification. Being able to go ahead and hedge against the public market is something that I see many investors wanting to do, and we'll certainly get into that here in the next few slides. Picking right up on that diversification portion, I want to take us into last week with a company that was publicly traded. It was a tech company. And it had done very poorly in the market a week ago. Many of you might know the stock to be NVIDIA. It has rebounded since, but something that occurred was a company owned by a Chinese company called DeepSeek that came aboard, had supposedly delivered a better product with 1/10 of the funding. And due to that, we saw some changes in the market. Now, the NVIDIA stock has quickly rebounded since, but this is a phenomenal way that people can diversify from the public markets, get all their funds out of that one basket in the public space, and actually start to diversify and start to hedge against the public market, especially in times of uncertainty. Job changes, as I mentioned, it's a very common reason that people will go ahead and take advantage of that. And then illiquidity as well. Maybe that investor doesn't have those funds in their checkings or savings account, or maybe it would be a way to go ahead and for them to double down on an investment. Say they are very attracted to investment. Maybe they make an investment of $50,000 to $100,000 out of their personal account. It performs well. Well, they're looking to reinvest and to supercharge that investment. Here's a way they could go ahead and put additional funds into an offering or a subsequent offering. And then tax mitigation. You aren't able to write off your losses, so it is a two-way street, but avoiding those capital gains taxes is certainly something that our investors appreciate. Now, when it comes to different types of retirement accounts, many different retirement accounts can be used and rolled over into a self-directed IRA. I'm going to highlight here on some of the most common ones. A 457 is definitely something that we're going to see, as well as a 403B. Everybody is very common with a 401k. That's typically what you contribute to with many W-2 employees. And then a thrift savings plan is another common plan that we'll see from time to time, typically going to be used by a uniformed service member. But what I really want to highlight here today is those IRAs and what the different types of IRAs, how they differ, the contribution limits and the like. In regards to those traditional IRAs, they're actually going to be pre-tax in nature. So something important when learning about pre-tax and post-tax, those pre-tax funds you're going to be contributing to on a pre-tax basis. Some are able to actually take deductions from their taxes based on their income level and where they're at and how much they're contributing. But when they actually go to pull those funds out of a traditional IRA is when they'll pay the taxes on it, and that will be taxed as ordinary income. The IRS will start requiring you to take those distributions at age 73. The limit for contributing here in our current tax year and in 2024 is going to be $7,000. If you're 50 or older, it'll be $8,000. I do want to call out a common misnomer in our industry. Most people think that I can only contribute for a tax year up until the 31st. That is certainly not the case. So you're actually able to contribute up until that tax deadline of April 15th. So for instance, if I wanted to contribute to the tax year of 2024, even though I'm in the calendar year of 2025, I'm certainly well within my privilege to do so. I could also contribute for 2025 in that same contribution as well, really helping to add to that contribution, to add to those investable dollars to where I could get invested into a real estate syndication with those funds. A Roth IRA is going to be post-tax in nature. A very interesting thing about the Roth IRA are those contributions are actually tax and penalty free after 5 years. So it is a way to remain in a semi-liquid state as well. So an important thing I want to call out there. With that Roth IRA, there is going to be a modified adjusted gross income limit for those investments. It's going to be $146,000 if you're single. If you're filing jointly, it's going to be $230,000. Now, there is certainly a way around that that's been used for over a decade now. It actually took effect into 2010, and that's what's known as a backdoor Roth conversion. So if you're above that modified adjusted gross income limit, you're not able to directly contribute to your Roth IRA. But what people will do rather is they'll open up a traditional IRA. They'll contribute to their traditional and do a backdoor Roth conversion, convert those pre-tax dollars to post-tax dollars, move them into their Roth account, and pay the appropriate taxes on that point of conversion. It's a very, very great way to go ahead and build compounding interest in the absence of taxation. Something I would strongly encourage everybody to seriously take a look at, especially if you're still in your working years and you plan to one day be at a higher income limit when you're starting to take those distributions than you are currently. If you see yourself finishing later in life in that higher tax bracket, maybe a Roth conversion is for you, and it's something to start seriously considering. When it comes to a SEP IRA, that actually stands for a simplified employee pension. It's going to be for any size business that can go ahead and have a SEP IRA. Now, only business owners are able to contribute to it, which is really going to differentiate it from that simple IRA. That contribution limit for the SEP is going to be $166,000 or 25% of their salary, whichever is lesser. The simple IRA will stand for a savings incentive match plan for employees. Now, this will be limited in size. In regards to business size, it will need to be 100 employees or less, but employees can contribute to these plans. Those contributions maxing out at $16,000 or $19,500 if they're 50 plus. Now, that SEP and simple are both going to be pre-tax in nature, which is going to be very similar to that traditional IRA. Once when you start taking those distributions later in life, they are going to be taxed as ordinary income. Now, a few other accounts I want to call out here before we jump into this next slide. An HSA, a health savings account, being pre-tax in nature, and an ESA, a Coverdell education savings tax, being post-tax in nature, are also accounts that you can actually self-direct and invest in alternative assets like real estate, and is a great way that people will use funds that maybe aren't having a great return that they have accumulated over time. Maybe they've had a family HSA plan and have really been contributing to it, maxing it out every year. Maybe they have a very healthy family. Maybe they're not really using that HSA. Maybe they're constantly going to the gym on Saturdays and they're cooking very healthy foods at home and they're not dipping into it. Well, here's a way they could go ahead and get those dollars working for them when they're not using them for those health reasons. So just more opportunities, more ways you can use those as vehicles. Inherited IRAs, I'll cover very briefly. They're IRAs that are inherited. The tricky thing with inherited IRAs, they need to be distributed in 10 years if you're not the spouse inheriting it, which make for good investments in real estate. Not a lot of holds will be for a 10-year timeline. So we will see many people go ahead, use them to invest in real estate syndications, continue to defer capital gains taxes, trying to keep it in that vehicle as long as we can until the IRS says, okay, it's time to distribute now and pay the appropriate taxes. But moving forward here, tips and considerations to use. You need a custodian. The IRS says so. No ifs, ands, or buts. Need to have that in place for this to all be above board. Something important I want to call out: it's the IRA making the investment, not actually the individual. So if I were to go ahead and invest my IRA into five Buffalo Capital here, hypothetically, I would be investing as equity trust company as custodian for benefit of Paul Herbis, account number 12345. Because all funds need to flow back into that IRA account as well. All returns need to flow back in that IRA account. It's what allows for you to have the ability to defer those capital gains taxes. Typically, it'll take 2 to 3 weeks to fund the IRA, depending on if we're doing an IRA to IRA transfer, which is definitely the shorter of those two lead times, or perhaps a 401k rollover or a defined benefit plan rollover. Those will take a little bit longer, typically 3 weeks, because there will be a 5-day check hold when that check is sent. What's the process? Open an account, fund it from your current custodian, either via wire transfer or check if it's going to be a rollover, and then go ahead and instruct us to get you invested into that real estate syndication. Pretty straightforward process. Now, what is a real estate checkbook IRA? It is not a specific type of IRA. So we went through the traditional Roth simple SEP. It's not any of those. What it is it's an LLC. And it's a manager-managed LLC, which allows that IRA account holder to have all signatory responsibilities for that LLC while keeping it all above board and having the only sole member be the IRA. A big benefit to this is limited liability protection. I'll typically see this used when it comes to real estate properties. Say you have a tenant in the building, always good to be protected by an LLC if you're transacting with tenants who are at the property where maybe something could happen. Maybe they fall down the stairs or something to that effect, right? Wanting to ensure you have that protection in place. And then transaction speed. This would actually constitute opening up a bank account for your LLC and allowing you to directly write checks and make investments as you see fit, just ensuring we're not investing in S corporation stock or life insurance, right? But what does this all entail, and how can we assist in this process? We can completely stand that LLC up for you. So whether it's the operating agreement, the articles of organization, the beneficial ownership form, the initial state filing, and even going ahead and getting that bank account set up with our partner Titan Bank, certainly something that we have much experience doing into helping our clients take control of their retirement funds as they see fit. Here's going to be that structure that I was just speaking to here. Funds would go ahead and move from our institution into that LLC account, where that IRA is going to be the sole owner, and to where you could go ahead and make all those real estate-based investments directly from it. Now, what are some considerations to have? Ensuring we're not interacting with disqualified persons is going to be a big portion of it. Paul, who's a disqualified person to my IRA? I would be personally. I'm not able to sell an acre of real estate that I own personally to my IRA. That would not be allowed, nor would I be able to do that with my spouse or any of my direct ancestors, so my parents and grandparents, and then any of my direct descendants, so my two girls, my children, or any of their marriages, my sons-in-law as well, would not be able to transact with them, or any of their offspring, so my grandchildren, great-grandchildren, and therefore down my lineage. Who can I transact with? I can transact with my brother. I can transact with my first cousin. I can transact with my uncle and aunt. The IRS doesn't believe any of those parties are going to do you any favors. That's why I'm able to transact with them. We want to be cognizant of self-dealing as well. So I even had a call this morning where I was speaking with a general partner who was interested in investing in their deal as a limited partner. Important to ensure they're not a majority owner in that fund, so that they don't own over 50% of equity in it, and also that they're not personally benefiting from their IRA's investment. So ensuring they're not monetarily profiting from specifically their IRA's investment, just their IRA's investment that they're making into it. So really ensuring that no self-dealing is occurring and that I'm not monetarily benefiting directly from my IRA's investment. Of course, I want my IRA to benefit monetarily. We surely want that with the IRA's investment. That's what we're looking for. But ensuring no commingling of funds is occurring. Cannot use that checkbook IRA for personal expenses. I can't use it to fill up my truck. Say I forgot my credit card at home. I've heard horror stories. So making sure we're not commingling funds. That investment account, that bank account is for investments. That's really what it is. So putting $50 of gas in my Chevy Silverado, unfortunately, as much as I like to think it's an investment, wouldn't necessarily be one. And then personal oversight, ensuring that we are doing record keeping. So with a checkbook IRA, you're going to want to keep a ledger. I'm sure most of you are pretty put together if you're going to be making substantial investments. So just ensuring that you have record of those investments, something important to have. What does the process look like to going ahead and creating one? First, you want to go ahead and establish that IRA. That way we have something to own the LLC. After that, we form the LLC. Open that account over at Titan Bank, transfer funds from our institution to the account of Titan Bank to where you could invest as you best see fit into an offering of your choosing. Now, switching gears over here to 1031 exchanges. What is a 1031 exchange? It is a part of the Internal Revenue Code. That's where it lives. It lives exactly in Section 1031. And it's a tax provision that was actually introduced over 70 years ago. So it's something that investors have been using for a very, very long time to defer not only capital gains taxes, but depreciation recapture tax as well. So certainly a multifaceted tool and commonly used by real estate investors. I'm not aware of any other different type of investment that you're able to do something like this. So I think it's a wonderful opportunity to really not only preserve wealth, but build it as well. In regards to preserving wealth, it certainly does that. So a 1031 exchange would ultimately allow you to have a stepped up basis. So I'll work with a lot of estate planning attorneys who are working with clients who may be towards end of life or who are considering what does the next generation look like when it comes to these investments and the wealth that they've accrued. Well, a stepped up basis is a great thing because their descendants would not have to pay those taxes as well, and it's a great way to transfer wealth. I'm going to cover 5 basic rules here today and highlight them that are very, very important to be aware of when entering into a 1031 exchange. The first one we're going to speak to today is the net selling price. Everybody always asks me, Paul, how much do I need to reinvest? How much do I need to reinvest? And typically, the preconceived notion is I need to reinvest the same amount of the property I sold. And naturally, one would assume that, right? I mean, that isn't unnatural to assume, but really, you're able to less those closing costs. So those sales commissions, those title costs, doc stamps, any of those miscellaneous expenses that you need to occur when you're going ahead and selling that relinquished property, you're able to actually subtract and arrive at that net selling price, which is the number that I need to go ahead and reinvest to defer all the capital gains taxes on my sale. Now, here's another preconceived notion. Real property. Most people think I need to stick in the same asset class. So if I'm selling raw land, most people would assume that I would need to purchase raw land. Certainly not the case. You're able to move different types of asset classes. So I could sell raw land and use those funds to purchase into a multifamily acquisition. Or I could go ahead and sell a single family home and get into a mixed use property. Certainly something that would be allowed. So real interest in real property is how it's defined in that Internal Revenue Code, and that's what we follow. You need to own that real interest in real property. A qualified intermediary is often referred to as a QI. That would be our role in regards to the 1031 exchange. We are going to be that unbiased party that's going to be going ahead and escrowing the funds, which is really what the IRS is looking for, that it's not an agent of the taxpayer, that it's not somebody on payroll of who's performing the 1031, making sure that it's all above board. Now, here are some timelines that are really important to consider as well when pursuing a 1031 exchange. The first one being the 45-day rule. You have 45 days to identify your replacement property, and that is 45 days from closing. There are 2 different rules you can use when identifying property. The first one being the 3-property rule. I can name any 3 properties regardless of their fair market value. 1, 2, 3. The most commonly used one. A lot of investors have a really good understanding and idea of what they want to replace into when they're doing this 1031 exchange. This typically isn't something that's haphazardly thrown together in the 11th hour. This is something that that people, when they're understanding that they're looking to sell property, are starting to ask the questions of what is a 1031 exchange, starting to look in the market, whether on market or off market, at looking at what to replace into. Now, the 200% rule differs as you're able to add an unlimited number of properties into that replacement with the condition that all of those properties you identify are not able to add up to 200% in aggregate of the property you're selling. So if I'm selling a $1 million property, I can list as many properties as I want, but those properties can't all add up to over $2 million. So something to keep in mind. I will see this used, not as commonly as the 3-property rule, but it's still used regularly and as a way to ensure we have a lot of those properties mentioned in case anything were to happen. Say, for instance, one of those properties closes on before I'm able to close on it. Say another buyer swoops in and takes it, or say we do a property inspection and there's foundation issues, and I am not going to be purchasing that property with foundation issues because I've looked at my underwriting, and to fix that would put me at a loss in the deal. So important to be cognizant of all these things when identifying properties, because after that 45-day rule, you are held to those properties that you've listed. And if you choose not to, and if you do not close on any of those properties, you don't have to close on all of them. But if you don't close on any of those properties, well, then we're certainly not going to be able to move forward with the 1031 exchange. So certainly something important to consider is having a strategy during this time. The 180-day rule, you have 180 days to complete the exchange. From closing to closing, does not matter if that 180th day falls on a federal holiday. It needs to be completed within a 180-day timeline. Now, this is a question I get asked very, very commonly. Does vacation property qualify? Yes, if. Yes, if is my answer here. So the property needs to be rented out at least 2 years before its sale. And that replacement property must also be rented out 2 years after its purchase. So the IRS wants to be sure here that it's an investment property, right? I mean, first and foremost, that's why we're doing a 1031 exchange, because we're deferring capital gains taxes on an investment property. But people will use these properties from time to time. Maybe the property's in Miami, Florida, or maybe it's in San Diego, California. And if you're anything like my family, you're in Sioux Falls, South Dakota in the winter, we like traveling to warm destinations. So certainly something that can be done. You can use the property up to 14 days or 10% of those days rented each year. So you are able to enjoy time with your family at those vacation properties, as long as those first 2 conditions have been met. Some other considerations that you're going to want to keep in mind when doing a 1031 exchange is how the deed is held, is how it must be held when replacing. It needs to be that same taxpayer. That's really what the IRS is looking at, is ensuring those taxpayers match up. The exchange needs to be in place prior to closing on the sale. I have had many heartbreaking conversations with investors that had heard from maybe someone else in the industry that they could do it after they've closed. Our hands are completely tied at that point. I would love to help these investors. I really would. We're not able to do anything at that point, and we cannot stand up that 1031 exchange at that point. It needs to be set up prior to any closings happening. Must. An important thing. If you write something down today, I would truly encourage you to write that down. The exchange must be in place prior to any closing. And then we're not able to 1031 exchange our primary home. We're talking about investment properties here today. We're not talking about primary residencies. Now we're going to cover the types of 1031 exchanges. There's 3 different types. The first one being a standard. When most people think of 1031 exchanges, this is what they think of. I'm selling first, I'm buying after. How would this look? We would work with that closing entity, whether it be a attorney or a title company, in going ahead and preparing the settlement statement for them, into which we would sign, as well as that taxpayer doing the 1031 exchange would sign. The sale would occur. We would escrow funds into an account held in your name to be held until closing. We would do the same thing when you would go ahead and secure a contract for closing. We'd prepare the settlement statement for that closing entity as well. And then we would go ahead, wire funds, get you closed. Your 1031 exchange would be complete, and you would be deferring those taxes. The second type is a reverse exchange. This is where you actually acquire a property before selling your property. And the way this is able to be achieved is through something known as an EAT, an exchange accommodation title holder, which is a single member LLC that's going to be set up on behalf of that taxpayer participating in the exchange. The way this is allowed is through that single member LLC. Ultimately, though, there are things to consider when going ahead and doing this reverse exchange that's going to differ drastically from the standard. And that's going to be if there's going to be any financing done to the property. They need to be okay with that third-party title holder, that EAT, taking title to the property, because that's how this must be set up if we're going to be doing this 1031 exchange and deferring taxes. Not every financer will understand that. We're more than willing to get on the phone with them, help explain, walk this through, and really help shore it up. Property and liability insurance coverage also are going to be set in place for that EAT. How would this work at the end? We would fully assign membership of that exchange accommodation over to you after your sales occurred, which would then make you the owner of that property fully. Now, the third exchange that we see less frequently than a reverse and standard will be known as an improvement exchange. And it also has that EAT portion of it, that exchange accommodation title holder, that single member LLC. So it is similar to the reverse exchange in that matter. How this differs is it allows people to go ahead and use their funds from their sale and actually use them to improve upon the property they're purchasing. So the order of this would be sale, purchase, improvement. And it allows them to use funds from that sale to actually go ahead and build upon that property. I've actually worked with investors who have purchased raw land and have stood up a complete building in that 180-day timeline. Now, it's important to call out here during that 45-day timeline, all of those specific improvements and the approximate values will need to be listed when identifying that property. So this is something that you would surely want to go ahead and have planned out beforehand. And only the work that's completed by the 180th day will actually count towards that exchange. So very, very important before even entering this exchange, if you're really considering about doing an improvement exchange, that you're reaching out to that subcontractor if we're doing a new build, or any contractor for that matter who's going to be contracted to do the work. The way that we're able to go ahead and do this is we're able to pay them directly out of that escrow account for their work. At the end of that 180th day, just like the reverse, we would assign that EAT over to you as the taxpayer, thus making you the owner. Heading into strategies here today. Many people will use 1031 exchanges to acquire property with greater income potential. The most commonly used that I'll see vacant land moving into residential or commercial, being here in Sioux Falls, South Dakota, is with a lot of farm families. Once when that leader of the farm would go ahead and maybe get close to end of life, they're going to start thinking of strategies when they're going ahead and passing down their wealth. Maybe the son and daughter went to school, maybe they got a college education, maybe one's a lawyer, one's a doctor, they have their own practices in different cities, they're very successful in their practices. This is where I will commonly see this used. The children aren't farmers themselves, so the father looks to go ahead, do a 1031 exchange, move from that farmland into maybe a multifamily property, maybe purchase multiple single family homes, and create that stepped up basis for his children while allowing the property to also cash flow in the interim. Consolidation or diversification, for that matter, is also something that I will see. I typically will see this consolidation occur with single family properties. Moving into a multifamily space is really when I'll see that consolidation happen. The diversification, the exact opposite typically, when they're moving from multifamily to many single family. I helped a gentleman a few months ago who was looking to sell his multifamily property, and due to that, he was able to purchase 3 different single-family homes in Florida with that, and he was looking to move markets. Also, to acquire less management-intense property is a common reason that I'll see this used. maybe somebody has been in the real estate world for 50, 60 years. They've done very well. They've really gotten a great appreciation on those properties. They've been able to cash flow over time, and but maybe they're in a different season in their life. Maybe they've changed one too many light bulbs, and they've gotten on one too many ladders, and it's become a headache for them having tenants. Well, we'll commonly see this used then as a way to get into properties that aren't such a heavy lift for somebody who may not have a third party, but may be doing all of the property management themselves. That's commonly when I'll see this used with clients that I work with. And I know I alluded to this earlier, but moving markets, that's another common reason. I've seen many, many different people over the past 5 years come from non-landlord friendly states and move into landlord friendly states due to numerous laws that have gotten passed even in the past few years at the state level. So we will see people go ahead and move markets for that reason and for other reasons as well. Maybe there's a very hot real estate market that they're really looking to get invested into, maybe somewhere like around the Texas area, as that real estate market has really taken off here in the past couple of years. Maybe they're looking to move from their property in Alaska and get into an area that they think is going to have a lot more immediate growth. At this time, I would absolutely love to open it up for a Q&A. Would love to be a reliable resource and answer some questions today and make sure I can get you guys some solutions.
Well, I don't see any questions, but I have a few. So while people are thinking of questions, and you answered some, I do see colleagues in the fund space, and they'll be like, "Yeah, I really get a lot of investment from folks who are doing self-directed investment through their IRA." So
Mhm.
walk our audience through the process. So if somebody says, "You know what, I've got this old 401k, don't want to put it in my current employer." Um, it's a nice healthy chunk and I'm an accredited investor.
Mm,
So they reach out to you. How does that process work? I know we covered a bit of it, but
Great
how
question.
can you help them with that?
Great question, Christina. So ultimately, we'd go ahead and establish the account first.
Mm.
That way, we either have a place to pull funds into or have funds pushed into. So the very first thing is we want to open up an account with the same tax status. So say they have a 401k with a former employer, and let's say it's pre-tax funds that they've been contributing to out of their paychecks with. We would then want to establish a traditional IRA to ensure that we also have that same pre-tax account, ensuring no taxable event is occurring during the movement of these funds. If they're going to be moving from a 401k, they would actually be pushing the funds over the current custodian. So we would then provide our client with rollover instructions to go ahead and get to their current custodian to have them push funds over. It's going to have their account number to ensure that it goes directly to their IRA. And then it's also going to have our check delivery instructions as well, whether their custodian is going to be overnighting the check or sending it via standard USPS. After we've then received the funds, we will then reach out to the investor to have them endorse the investment documents between them and that syndication that they'd be investing into through DocuSign. After they've endorsed those, they'd be able to give us a call and give us a verbal authorization, and then we'd send the wire over and their IRA would be fully invested. Now that's the example with a 401k rollover where funds are pushed. Say they're transferring from an IRA.
Mm.
I would ask them for their account statement at their current custodian, and then also for them to endorse a transfer form as well. That transfer form is going to serve as our permission slip so that when we go to that custodian, we can freely pull funds. Now, there are some things I want to annotate here. The first one being that the funds will need to be in a liquid position for us to pull them. So they would, if they're held in the S&P 500 or in a mutual fund or something like that, the client would need to go ahead and sell off those securities and have the funds sitting in per se like a money market account in a liquid position, so that when we pull upon it, we don't get that transfer rejected. The transfer form We try to make everything easy. Our application's online. It's digitally done via DocuSign. We're able to do that with our transfer forms. Some custodians play very nicely. Some are still very archaic in brick and mortar. So some transfer forms will need to be pen signed, depending on who your custodian is. And of course, that's something that I would be able to help assist with and ensure that we get them taken care of. But it would result in the same process: funds arriving over, them endorsing electronically the investment documents, and giving us the verbal.
Gotcha. And do you guys, when someone is a client and they have an account with you and they come up and say, I want to invest in this, do you guys do any investment oversight, or do you just say yes? How do you all kind of
Yeah,
handle that? Because there are some prohibited transactions. So how much oversight
great
would
question.
we kind of,
Yeah,
say, hey, maybe that's a bad idea?
yeah, great question. I'm able to speak anecdotally, so that's
Okay,
something that I'm able to do. I can speak from my my personal experiences and my clients' experiences. I'm not able to give legal and tax advice, nor am I a
of course.
fiduciary, but I can certainly speak to prohibited transactions. That's certainly something I'm able to speak to. Ultimately, ultimately we serve as the custodian, so we would just get them invested. It's really going to be on that investor. But if they would ever like to discuss prohibited transactions or anything of the sort, I would be more than willing to have that conversation and be a light on a hill.
Um, so Dustin asked, can someone move from oil and gas to real estate? So if they decide, I don't like this investment, or I want to
Hmm.
diversify within that same IRA,
Great question.
how have you seen that work?
Yeah, if they own the land onto which the oil and gas is on, they certainly could. They certainly could. If they own the land, um, something that would certainly be able to be done because it's a real interest in real property. Now, let's say they were invested into a fund structure, which I see many oil and gas offerings as, typically a Reg D, 506C or 506B. If they're invested that way, they actually own private equity shares. So they
Mhm.
don't actually own the property themselves. They don't own that real interest in real property. They would own equity shares, which would not be able to be 1031 exchanged. So it would need to be a real interest in real property, whether that's a tenancy in common with another entity. Maybe it was set up as a joint venture, and they actually own the property. It really depends how it is structured.
And I know with our fund, we provide our investors a K1 at the end of the year. So with let's say a client of yours invested in our fund, with those K1s are going to go back to the IRA, and all of the tax benefits are going to go to the IRA whole, or the IRA, not the individual. Is that correct?
Yep. So it's all IRA based.
Okay.
So it's going to be the ultimately the IRA. And then I know we touched earlier. The capital gains taxes is
Mhm.
a two-edged sword, right? I mean, we're able
Yeah.
to go ahead and defer them, but the IRS doesn't necessarily want us to have our cake and us to eat it too. So we're not able to write those off in turn.
Gotcha. And that makes sense. But I know that would be a question people would have, is what happens with these documents, and then, how does that transact? So
They'll
definitely
they'll
something
s-
to.
they'll still receive the K1,
Mm.
and they'll be able to report that information on their tax return appropriately.
Awesome. Well, Paul, what do you see as the biggest aha moment that people have when they set up these accounts? What do you hear people say? Oh, I wish I'd known this sooner. Like, what's kind of the aha about it?
Mhm. In regards to how simple it is. I mean, a lot of people think it's going to be a really long, drawn out process. They think that ultimately it's going to be something that's going to take many, many months, and really that's not the case. I mean, this is something that could take 20 minutes to go ahead, open. In some instances, I've seen it take less than a week to actually go ahead and fund. So something that doesn't require a heavy lift in regards to that account holder. Um, other strategies that I commonly see aha moments, Roth conversions. I mean, Roth conversions are a really, really strong, powerful tool to build that compounding interest in the absence of taxation. I mean, that is a wonderful thing. And if you're able to take a hold of that early on in life, um, you can really see some great returns that you're not going to be paying any taxes on because you've already paid taxes on the seed, and you're able to watch that grow into a beautiful huge oak tree, and yeah, see those returns accordingly, and not have to get hit over the head by the tax man once when you start taking those distributions later in life.
And I'm glad you touched on 1031s, the qualified intermediary piece, because that is something that people throw the term 1031 exchange around a lot. And I was
Mm.
talking to our tax preparer, our accountant, and she told me a horror story. As we were getting ready to sell a property and we were talking about 1031 exchanges very early on in our career, she said, make sure you have a qualified intermediary. And I said, that's a great point. Thank you for sharing that. She's like, I had a client who did not and came in and it was tax time. You never want
Oh
surprises at
boy,
tax time, right?
no.
And they had said, oh, yeah, no, I did a 1031 exchange. I got out of this property. I got into this property. The properties were fine. It was the fact that they did it themselves. So in their mind, they thought they had
Mm.
completed a
Oh
1031
no.
exchange
Oh
and
no.
had all their documentation, except they didn't use a qualified intermediary. They took
Yikes.
the money from the sale personally and put it into the purchase, which you cannot do. And
Nope.
so she was just like, I want you to be very clear on this process. And so the 45
Mm.
days, the 180 days, the three properties, I've experienced it and it's a powerful tool. You can do it. Just find a great qualified intermediary. So I love that Equity has that service so that people who are wanting to use these IRA accounts can do
Right.
it within that structure and not have to move outside of
Mm.
that ecosystem.
Mm.
You guys provide that.
And not all qualified intermediaries are created equal, and I really want to call that out because it is a very unregulated industry. Now, us as a custodian and administrator on the IRA side, that is a very, very regulated industry. Now, on terms of the qualified intermediary, not so whatsoever. I mean, it is highly unregulated. I've heard horror stories of um, escrows going out and qualified intermediary companies and owners fleeing the nation after they've received that wire. So, um, yeah, it's certainly something to be aware of. You want to work with an institution that's been around a while, that's going to continue to be around a while, even if it means saving $100, $200. I would strongly encourage that individual to work with a well-established entity that also has certified exchange specialists on staff. So, we have multiple CES designations on staff, which we're really proud of. These are individuals that have passed a rigorous exams, and who also are bound by a code of ethics and morals as well. So something that we're really proud to showcase and have as well.
Well, Paul, I don't see any further questions, and I know it's lunchtime. We we appreciate your time today and covering how Equity Trust as a custodian can help folks diversify their portfolio and invest in things that aren't just in their employer plan or just in the market,
Mm,
but really broaden those horizons. So we will let you get on with your day, but thank you so much for taking time with us.
my pleasure, Christine. I really appreciate the opportunity, and yeah, I want to extend thanks again to Five Buffalo Capital, and yeah, thank you so much.
Awesome. Well, we have another webinar coming up in March. That one is going to be talking about health and how health is your wealth and how to take different health tips to save money that you could invest and how, of course, real estate can help support that. And then again, Paul did drop his information in the chat. So it'll be there, but also you can see him on LinkedIn. You can find Equity all over the internet. We have their information on our webpage. And if you are just catching the second half of this webinar, you can certainly see it on our webpage as well. And we'll have more information provided about the fund if that is something that interests folks. So I do encourage everybody to go to Equity's website. There's a lot of education on there. It's great, lots of great blogs, and you guys do a good job of educating people and letting them self-educate before they work through their financial plan with an
Mm,
advisor or just on their own. So really appreciate that.
thanks so much, Christina.
All right. Well, Paul and everyone else, we'll let you guys get through with your day. Have a great one, and we appreciate you being here.
Thank you.
Thank you.